Anthony Grasso here, bringing you financial news that you can use. In this video, I'm going to do an updated stock analysis on Bionano Genomics. Have I changed my sell recommendation from last year on this penny stock? Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections, and give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing and hit that notification bell to like your daily stock reviews and recommendations from an unbiased source. So let's get right into it. So this video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you can get up to 12 free stocks by using my referral link in the description down below. So Bionano Genomics, it provides genome analysis software solutions. It offers Sapphire, which is a sample to result solution for structural variation analysis by optical genome mapping for genome analysis and understanding of genetic variation and function. Now the Sapphire instrument, which is a single molecule imager, they have the Sapphire chip. They have a consumable, that's a consumable that packages the nano channel arrays for DNA linearization, and Bionano prep kits and DNA labeling kits, now which provides the reagents and protocols for extracting and labeling ultra-high molecular weights. Now the company also provides Sapphire and Bionano compute service servers, and NX Clinical, which offers one system for analysis and interpretation of genomic variants from microarray and next generation sequencing data for cytogenetics and molecular genetics. Now, in addition, it offers testing and laboratory services comprising of First Step DX Plus, a chromosomal microarray for identifying an underlying genetic cause, individuals with autism, structural disorder, developmental delay, and intellectual disability. The Fragile X syndrome, FXS, testing services, the Next Step DX plus an exome sequencing test to identify genetic variants that are associated with disorders of childhood development, and the EpiPanel DX Plus, which is the genetic testing panel for patients who have experienced seizures, infantile spasms, and a few other things. So they were headquartered in San Diego, California. So let's go ahead and look at some of the news that made the stock jump up in the past week or two. So the company announced last week that the publication of the first study to evaluate the utility of optical genome mapping, OGM, and the analysis of repeat expansion disorders. Now, biogenomics says repeat expansion disorders are a class of disorders that impact approximately 1 in 3,000 people and are caused by expansions of short tandem DNA repeats. Now, in this study, Bionano says researchers screened 626 samples for the presence of the AAGGG and repeat expansions in the RFC1 gene using the combination of PCR to detect repeat sequences and OGM to determine the size of the repeat expansions. Now, it says OGM confirmed the presence of expanded RFC1 alleles in all cases where it was used as part of the workflow. Repeats identified using OGM were in the range of 800 to 1,200 repeat units. OGM is well suited for analyzing large repeat expansion disorders that require the measurement of long intact DNA molecules for accurate sizing, as well as was observed in the study. Now, they've also highlighted the study noted successful use of OGM to replace the labor-intensive and time-consuming Southern blot. Now, this is the important part, which has been the gold standard for sizing repeat expansions up to now. Eric Holman, the president and chief executive officer of Bionano, said, "We believe this study helps demonstrate the important role of OGM can play in understanding the most complex regions of the genome, and that OGM is well suited for the analysis of repeat expansion disorders that require the measurement of long intact DNA molecules for accurate sizing." Now, he said, "We plan to continue developing better tools for the detection of a range of repeat expansion disorders, including those causing adult onset ataxia and canvas." They are optimistic that adding OGM repeat expansion disorder research can potentially lead to better diagnosis for patients and more accurate data for neuroscience researchers. All right, well, that's great news of the company, and this is why when news of this happens for Bionano in the past, the stock price has jumped up. So let's go ahead and look at some of the fundamentals specifically regarding this company. So the company's current market capitalization is $1 billion. Last year ago, when I reviewed this company, it was $1.92 billion over a year ago. The projected 2022 revenue should total around 26.4 million with negative 126 million in earnings. The revenues are projected to increase to 97 million by the end of 2024, but the earnings are still projected to be significantly negative at around 98 million by the end of 2024. And let's go ahead and look at some key measures of this company right now. Let's look at the valuation analysis real quick. Because the earnings are negative of this company, the price to sales and the price to book ratios are the most appropriate valuation measures. Therefore, the company seems highly valued with a price to sales ratio of 37.32 times, one of the highest in the industry. However, their price to book is only 3.06 times, in line with the industry median of 3.4 times. And let's look at the profitability for this company in particular. Based on its gross operating and net margins, the company has a cost structure that eats up a percentage of its revenues that are among the highest of the company in that industry. To make matters worse, the company is losing money on an operating basis. It has a negative profit margin of 453%. That is significant. And they don't pay any dividends like its peers. And looking at the growth of the company, they saw earnings decline in spite of positive revenue growth during the past 12 months. Additionally, the average company in the life sciences, tools, and services industry was able to improve its earnings result over the same period. Now, the company's revenue is forecasted to grow faster than 20% per year. It's about 53% per year. But their earnings trend is unprofitable and losses have increased over the past 5 years at a rate of 38.7% per year. And the rate of the earnings negativity is going to increasingly decline into 2023 before it makes that still negative but upward trend. Looking at the financial strength of this company, they have little to no debt, thus little financial risk right now. The short-term assets of 216 million exceeds both its short-term liabilities of 27.9 million and its long-term liabilities of 8.9 million. Now, future cash runway, they have enough cash runway for about 1.2 years if the free cash flow continues to reduce at historical rates of 34.5% per year. This is because they raised significantly money in the past year. Shareholders have been significantly diluted in the past year, with total shares outstanding growing by 3.9%. So what exactly do the analysts say regarding this company? Now, the analysts have a strong buy recommendation with a price target over the next 12 months of $8.67 a share, with a high of 12 and a low of 6. Going over a few of the analyst reports in particular. Now, the Street Quant Ratings rates a sell recommendation. This is driven by a number of negative factors which they believe have a greater impact than any strengths and could make it more difficult for investors to achieve any positive results compared to most of the stocks that they cover. The company's weaknesses can be seen in multiple of areas, such as the deteriorating net income, disappointing return on equity, weak operating cash flow, generally disappointing historical performance in the stock itself, and feeble growth in its earnings per share. The CFRA report also has a sell recommendation on this company, and it's based on its score from the quantitative model for the United States they use. They said the quality and valuation model subcategories are the two largest drivers of the sell recommendation. The quality factors include profitability, cash flow generation, operating efficiency, and earnings quality. And the valuation factors include price to earnings, price to EBITDA, and price to cash flow. So let me bring it back over here. So my buy, hold, or sell recommendation on Bionano Genomics. Here are my thoughts. Now, this company has a wild ride, shooting to the moon last year and crashing way back down to earth like I predicted. Check out that video above. I have issues with recent stock dilution, decreasing revenue, unprofitability projected for the next 3 to 5 years. Last year, it was pure speculative trading that took the momentum of the stock into unrealistic and unsustainable stock valuations. Also, people were commenting wildly on messages boards saying easy money, 100 times stock price, and rapid trading. They were all trying to pump and dump the stock. Now, it is true that Bionano is creating a piece of hardware that isn't necessarily something that is out there widespread recognized need for within the biopharmaceutical world. Even if the company's claims about the Sapphire's capabilities being non-replicable using other individual devices are entirely true, many laboratories are apt to continue using their existing assortment of techniques and alternative systems to get the same data. Likewise, even if it's true that the Sapphire is more time efficient than manual techniques or other approaches, it might be a hard sell to potential customers who don't think that the system's time-saving capabilities matter that much in the scheme of their business. So based on all of that, I am a sell recommendation at the current price. This is a pure speculative bet. If you're a day trader, this might be the one for you to trade the price fluctuations. Short-term investors might be able to trade the swings, but after the news subsides, the stock price, in my professional opinion, will end up coming back down from its recent highs of the past 2 weeks and settle between the $1.50 to $2 range right now. It will take years for this company to come around and become profitable. I mean, 5 to 8 years. And that's not a short time. I have to say, though, I love the company. I love what it's doing, and I do think they're on the right track. But from a solid investment strategy, the fundamentals are still not there. But its business model is still attractive due to its long-term recurring revenue potential. Developing new consumables and new devices will also propel some future growth at some point in time. That is not likely to be seen anytime soon. Now, this penny stock might be getting ready for a short squeeze as well. TD Ameritrade has this company with a short float percentage at 16.02%. Now, I would only buy into this company at the $1.50 to $2 range and target a 5 to 8 year time frame to be able to sustain a $10 share price. If the company continues innovating, increasing revenues, and its forecasted estimates stay on course, then again, any future dilution in the stock to raise money to stay afloat could affect any of my future projections. It's not just me. It's not for me in the near term at the current stock price. And this is a really risky on the level of risk of 1 to 10. This is at your 9 to 10 mark on the level of risk, and it's for long term. So there you have it, folks. And as always, don't forget to smash that like button down below. It definitely helps. And consider subscribing. Hit that notification bell for like your daily stock reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.